Today's talk is about affordability. I do a lot of research for the markets that I practice in, Northern Illinois, Rockford area, and the Northwest suburbs. But I also watch a lot of national videos, trying to understand what the trends are, see what markets are rising or falling, so I can understand what's going to be taking place here and give great advice to my clients. One of the videos that I watched on YouTube in the last week or so really did catch my attention because it was about affordability. And what does affordability mean? Well, to break it down just simply, it is the amount that it costs you for your mortgage payment, principal, interest, taxes, and insurance. So PITI, your overall monthly payment for housing versus what your gross monthly income is. And so the percentage of that is the affordability of the housing market. And that tracks over history to average approximately 35%. So the average U.S. household is paying 35% of their gross monthly income towards their mortgage payment. Where's that index at right now? Well, as of February 10th, 2023, it is approximately at 56% on a nationwide basis. That's probably difficult to sustain. It's hard to qualify for a mortgage. So something has to give. Either new mortgage products need to become available. We're hearing a lot about a 2-1 buy down, which is a short-term solution where you're betting on the fact that interest rates will be lower in a year or two compared to where they are right now. But a 30-year fixed rate mortgage is not going to drastically change in percentage. So what other options are there? I Googled a 40-year mortgage to see what that's about. And the issue with a 40-year mortgage is it's not being readily available and not being purchased by the secondary market like Fannie Mae and Freddie Mac. So that creates an issue where maybe you can get that through your credit union, different private lenders, but those options typically are much more expensive in interest rate. So the savings on a monthly basis may be minimal. I'd like to see some solution come about that can give some peace of mind to the market if prices are not going to ease. You know, it's okay if prices don't come down, but we've got to have a way to still afford those homes. I'm not thinking that prices are going to fall significantly, and if they do, it will be a slower process. They fell from June till now about 5.9% on a national basis, which is significant. That's took 3 years for home prices to fall that quickly the last time that they came down. But it's not outrageous to think that prices will not really come down, even though they shot up 40% from 2019 to today or to June of last year. They're probably not going to drop that much. So interest rates have gone up. Affordability has become a huge issue. We're 21 points above where we should be, from 35% to 56% in affordability. So my thoughts right now are just basically saying I think Rockford is very fortunate because it's still affordable. The median average price, home sale price in Rockford and the surrounding towns is still in the affordability range for most home buyers. Where I think we're seeing a struggle are the higher end markets like the Northwest suburbs, where the average sale price is more than double what it is in Rockford. And so affordability becomes a significant issue there. So to make this bottom line, home affordability is going to influence prices. Now, inventory is impacting what's going on in the marketplace right now. But if inventory starts to grow and affordability doesn't change in some way, either by the 30-year fixed interest rate coming down significantly or new mortgage products being offered to the consumer, that's where I think we might start to see inventories rise and days on market increase and basically run into a situation where prices will have to fall. It's a waiting game. We'll see what happens. But the affordability is something that just really stood out to me this week of all the different articles I read and videos I watched, analyzing where the real estate market is in 2023. Having an affordability index that's 56% of your gross monthly income, obviously that's not going to be sustainable over the long term. Or we're just going to end up with a bunch of people that won't leave their house because they can't afford to do anything else. All right. That's my take for today. Thanks for watching.